Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of October 30th. U.S. stocks, as measured by the S&P 500, were lower last week. And as you see here, they're now at the lowest level since April. Market weakness was primarily driven by three factors. First of all, volatility in bond yields. For example, the 10-year Treasury yield breached 5% for the first time since 2007. And we all know higher bond yields hurt stocks because higher bond yields equates to higher borrowing costs. Second of all, though earnings season has been much better than expected, we are seeing some very underwhelming earnings guidance from companies looking forward. And third of all, rising geopolitical concerns in the Middle East. So we do expect market volatility to continue as the markets grapple with these concerns. But there's some positives that we can look at. First of all, as you see here, valuations are much more attractive. For example, the PE ratio of the S&P 500 has fallen pretty quickly from 19.8 times forward earnings to now 17.1. Stocks are more attractive. Second of all, the Fed, in our opinion, is done raising rates. This takes a market overhang off the table. Third of all, economic momentum is pretty strong. For example, last week, we got third quarter GDP. It came in at 4.9%, well above expectations and well above second quarter GDP of 2.1%. This pushes any potential recession out further down the timeline. Looking at this week, we'll get data to give us more clues in terms of what the Fed is doing and to what extent third quarter economic momentum carried into this quarter. So let's start with the Fed. The Fed meets on Tuesday, Wednesday. No surprises expected. The Fed should keep rates unchanged because inflation is slowing. The economy hasn't fully felt the effect of higher rates, and higher bond yields are likely impacting economic growth. In the Fed meeting, though, I'm going to really focus on Powell's comments afterwards. In particular, does he discuss the fact that tightening financial conditions, in other words, higher bond yields, do they reduce the need of the Fed to further raise rates? Turning to economic data, again, the key theme to watch is, did economic momentum in the late third quarter carry into the fourth quarter? We get three reports to provide a first look at last month's economy. Wednesday, we get a reading on manufacturing, ISM manufacturing. Friday, we get a reading on services, the ISM Services Index. As a reminder, for both indices, above 50 is considered expansionary. Also on Friday, we get the bigger report, the payroll report. Markets expect a slowdown from September's 336,000 jump in jobs. The Fed wants a slowdown in labor to reduce the services inflation. So the big key takeaway this week, markets are jittery. Higher bond yields, what the Fed will do, and geopolitical risks. But this week, we should confirm that the Fed is done raising rates and economic growth remains solid. Both could shift market sentiment to be a little bit more optimistic. Thanks for listening. For more information, please follow us on Twitter at Cetera IM, and see you next week.